Hey, it's Trevor Cochran with Reverb Financial, where we design financial plans that are intended to last beyond you and bless the next generation. Today, we are talking about life insurance. We got questions all the time regarding what type of policies we should be considering, how much life insurance should we have, and in this video today we want to address some of those common questions that we get. Every life insurance policy has essentially three components. There is the premium, or how much you're paying per month or annually or semi-annually, however you decide to pay for it. There is the death benefit. We also call that the face amount value. Essentially, hey, if I was to pass early, how much would my benefactor get? That's the death benefit. The third component is the cash value. There's some types of insurance policies out there that actually, as you put into the policy, it builds up cash value. There's pretty much two types of life insurance out there. There's term. Term is very much like car insurance. You get the biggest bang for your buck. It doesn't build up cash value. You get to set the term. Hey, I want 10 years, 15 years, 20 years of life insurance, and that life insurance premium does not change at all as you go forward. It is by far the cheapest form of life insurance for most people out there. So on the other side of the fence is permanent life insurance. Permanent lasts your entire life. It has the opportunity to build cash value. It costs a little bit more, and it is subject to rate hikes along the way. But let's rest here for a second, and we're going to talk about the primary purpose of life insurance. The primary purpose of life insurance is to provide a death benefit to somebody else who would otherwise be financially burdened by your passing. So, if we think of life insurance in that context, we got to ask ourselves a question. Why would somebody else need a death benefit? Well, there's a couple main reasons. First of all, that person may be relying on your income while you're alive. That person might be relying on your paycheck, whatever job you have, the income you're bringing home, and relying on you to provide that. That could be your spouse, that could be your kids, maybe that's even your parents, somebody else in your life that's relying on your income. That's the first reason someone might need a death benefit if you pass away. The second reason is maybe you have a lot of debt. Debt doesn't just go away. Debt doesn't just disappear when you pass away, and someone might be inheriting that death and have that financial burden. It's the second reason they may need a death benefit. The third is that perhaps it's to help cover the funeral cost. If for any reason your death causes a financial burden for somebody else, you probably need some sort of life insurance coverage. If you're single, you don't have any debt, you don't have anyone dependent on you financially, chances are you don't really need life insurance unless you're going for a secondary reason for it. If the answer is yes, somebody will be burdened financially if I was to pass away early. The next question we need to ask is, well, how much life insurance do I actually need? There's a lot of different trains of thought out there for the actual amount that people need. So I'm going to run through a couple of them that I've heard before, or I've heard people teach this before. The first train of thought is that you need enough to cover your debt. Essentially, if you're to pass away, your debt might be inherited by somebody else. If you're single, no one else is financially dependent on you, but you have a lot of debt, you probably need enough life insurance to cover that. If you're married and your spouse is relying on your income, you probably need a lot more than that. The second train of thought that I've heard quite a bit is that you need 10 times your annual income. So, for example, if you make $50,000, you need $500,000. If you make $60,000, you need $600,000. Anyone can do the math on that. It's great because it's going to provide for some short-term income needs. It's not so great because it's not going to provide for long-term income needs. If you have 10x your salary and you decide you're just going to put that in cash, you're going to pull out $60,000 a year, that's going to last for 10 years. Unless you decide to invest it a little bit, it might last a little longer than that. The third train of thought that we regularly teach here at Reverb starts with a question. And the question is this: how much income would my dependents need per month to be able to move forward without my death being a financial burden? So let's use this example. Let's say that you've done the numbers, you've broken down, hey, if I pass early, my dependents will need $2,000 per month. That's what they'll need. That's what's gonna make their lifestyle okay. That's gonna help with the kids in college. That's gonna help with my spouse. She's not gonna have to sell the house or anything. So you land on that number. They need $2,000 a month. So 2,000 times 12, well, that's $24,000 a year. So now we gotta take that number and say, well, what death benefit is going to provide that sort of income? And to find that number, we need to take a slight pivot. We're gonna pivot and talk about investing for just a second. So in the investment world, there is a rule of 4% that came out in the 90s. A financial advisor put this together, and it's largely adapted in our world to be a rule that, hey, if you go into retirement and you've got your retirement funds, you can generally take about 4% of those funds out in retirement to live off of. So if you have $500,000 saved up, you retire at age 60, you can take out about $20,000 per year. If you have $1 million in retirement saved up, you can pull out about 40 grand per year. So it's a rule of thumb, and every thumb has a flaw, so that's fine. Anyway, that's a general rule in the industry that you can pull out about 4% in retirement when you go into your golden years. So if we were to take that rule and say, hey, with my death benefit, I would want my surviving dependents to invest this and create some sort of income where it'll allow the investment to hopefully grow over time and provide them over the next couple of years, give them the income they need if I was to pass away. So let's take that rule of 4% that we use in investing and say, what would that look like with life insurance? Well, back to the illustration, they need $2,000 a month. That's $24,000 a year. Well, $24,000 is 4% of $600,000. That could be an example of how you arrive at that death benefit. So if they needed $4,000 a month for my family to be okay, well, you'd arrive at 1.2 million. If you wanted to use some investment principles with it, say, hey, we're gonna invest this, we want to live off of that. So that rule of 4% is pretty easy to arrive at. Find out the annual income number you think your dependents would need if you were to pass early, multiply that by 25. So that's the first question you need to be asking yourself. If I was to pass away, would my dependents be okay financially? What number do they need per month? Translate into that to numbers per year and translate that into 4% of. That's one way to help you arrive at that death benefit number. The second question we have to ask is, how long do you think it will take before you passing away would no longer leave a financial burden for others? And really, to know the answer to that question, you need to have a proactive financial planning strategy to help you invest those assets to get to that number that we call self-insured, where if you were to pass away or something tragic happens, your family's going to be okay no matter what, because you're diligent throughout the years to save your money, put it aside, invest it toward your future self. For example, let's say you sit down with a financial planner like myself here at Reverb Financial. You put together a plan to get your assets to where they need to be by the time you retire. Let's say that's age 60 or 65. Well, now your life insurance ought to be bridging the gap between now and retirement. Since we view life insurance primarily as helping people that are financially dependent on you to move forward if you're to pass away, and primarily as bridging a gap between now and retirement, we typically recommend term life insurance. Though there are some pretty cool parts about permanent life insurance, we view permanent life insurance as a secondary purpose when it comes to what we really need. There's some estate planning, there's some other cool stuff we can do with that. If you'd like to hear more about permanent life insurance, let us know. We may create a separate video on that. We really want to create content that is relevant for you. But if your biggest need right now is to bridge the gap between now and retirement, there's people that are relying on you financially, term life is probably going to be a great solution. Contact us, we'd be happy to help with that. Contact us for your investment needs too. We like to put the whole thing together. A protective plan is just the start of a financial plan. The proactive part is where it gets really fun. We hope you enjoyed this video. Comment, let us know what else you'd like to hear from us and if this was helpful for you, or send us an email, trevor@reverbfinancial.com. We'd love to hear from you.